Asia, as you know, is back in focus for us this morning. We've got a new government in Japan, the plunge overnight in Chinese stocks, and a key piece of economic data coming tomorrow, China's Purchasing Managers Index. Few people really can make sense of this region for investors. One who can, however, is Andy Shia, a guest columnist at the influential mainland magazine Caiji, and former chief economist in Asia for Morgan Stanley. He's with us from Shanghai this morning. Andy, it is really great to have you. You've said Chinese stocks are a Ponzi scheme, a giant Ponzi scheme. In fact, that is one provocative statement if I've ever heard one. They're down almost 25% from their recent peak in early August. How much do they have to go before the correction is over?
Even at today's price, it's very expensive. It's about 3 times book value, and the in terms of PE is still very close to 30 times. And at the peak of the market a month ago, about close to 20% of the stocks were traded at over 100 times earnings. So I think that I'm not sure this is the final bust. I think that it's a liquidity scare. And it's possible the market might recover a bit in September. But I think that the market is still is in deep bubble territory.
Okay, if it's in deep bubble territory, I'm assuming then that a recovery in September is going to be short-lived. Cast your eyes forward 6 months. Where are Chinese stocks going to be then?
Well, I think a normal valuation for Chinese stocks probably should be like 2,000 or less. And when the last bubble burst in 2008, it bottomed at about 1,700. I thought it was the right valuation. At that time, I sounded optimistic, but it came back, roared back because the government boosted bank lending to support the economy. Instead of supporting the economy, most of the money was diverted for stock and property speculation, creating this bubble. Now, it has substantially complicated the job for economic management for the government. The government now is pulling the plug on liquidity, and they are trying to shift it towards economic restructuring. Hopefully, it's not too late.
Okay, Andy, you're talking about the Shanghai index going into 2,000 from about 2,667 right now. You talk about liquidity. How real is China's economic recovery? Is this just all inflation, effectively, asset price inflation due to excess liquidity being pumped in by the government stimulus?
I think that as the inflation has lifted the economy in the short term, in particular through the property sector, and the property sales are 10% of GDP and account for half of the local government's fiscal revenue. And the bank lending went there and boosted property prices and led to the construction increase of the property construction quite a bit. So that supported the economy. But other than that, we also saw a bit of boost in highway and railroad investment. These are the two pieces, and plus the inventory cycle. So I don't think that the economy, the reasonable quick recovery is sustainable. We are probably going to see some sort of a slowdown in the fourth quarter.
Okay, Andy, please hang on. I have more questions for you about China. I have some questions for you about the U.S. economy as well. We're talking to Andy Shia. He's the former chief economist in Asia for Morgan Stanley. And, of course, we'll be talking to Andy. We'll also be talking about Warren Buffett when we come back. We're taking a break for maybe 2.5 minutes. Don't go away. We're back with Andy Shia, guest columnist of the influential mainland Chinese magazine Caiji. He's also a former chief economist in Asia for Morgan Stanley, with us this morning from Shanghai. Andy, just before we went to break, you told us that we might actually see Chinese economic growth slow in the fourth quarter. That's going to surprise some people who see China as the economic engine for the rest of the world right now. Let me ask you this question. What's the most dangerous assumption we can make about China right now?
Yeah, I think that China has been an export-led model, and China has enormous potential with 1.3 billion people and with urbanization. So a lot of good stories going on. But the issue is that with the global downturn, exports are not likely to lead the economy anymore. So China needs to rebalance the economy. The stimulus in the past 3 quarters since the beginning of the year has not been towards changing the economic model. It's been inflating asset markets and increasing investment, i.e. increasing the imbalance in the economy. So that is why the recovery is not sustainable. And I think that China changing its growth model will take time. I think a lot of people, especially in the stock market, have fantasies about China. I think one thing to remember is that changing economic model, it takes time. Let's look at Japan. It's been 20 years and it still hasn't done so. I think, of course, I don't believe that China will follow Japan's path, but it takes time. It takes at least a couple of years.
All right, obviously your predictions, anyway, have some serious implications for the Chinese economy and investors worldwide. Andy Shih, I want to thank you very much for joining us. Andy Shih, a columnist at Shaiji Magazine, former chief economist for Morgan Stanley in Asia. He left that firm after spoke his mind with us this morning.